Friends, welcome to our today's session. I will be continuing our discussion on the fourth unit. Fourth unit deals with long-term investment analysis. In that context, we have already discussed this point, investment idea generation. These concepts has already been discussed with you. Today, we are supposed to learn about this thing, tools and techniques of analysis of risk in capital investment decisions. When you talk about capital investment decisions, which are also referred to as this thing, it's a kind of investment decision. Investment decisions, they're called as capital budgeting decisions. They're capital investment in the sense huge amount of money is involved and they're irreversible decisions also. Once you have decided to start a plant, you have to bear with it. Now, let us first of all discuss what are the various methods used to take this kind of decision. For example, payback period method, like this internal rate of return, net present value, some of the things, some of this concept we will be going to learn in detail. There will be a separate session which will be teaching you all these things. We'll be today at a very surface level, we'll have some idea what are these tools and techniques. Then we'll move to the concept of risk analysis. So let me share my screen with you right now. If you look at your screen, I think screen is shared with you. If you look at your screen, you can see this chart shows there are various techniques of capital budgeting or various techniques of taking investment decisions, long-term investment decisions we're talking about. First, you see the broadly two categories, non-discounted method, or they can be referred to as traditional methods. Next is you see discounted methods or time-adjusted method. When I said discounted method, what does it mean? It means, you see, friends, we evaluate these projects or evaluate this kind of investment decisions on the basis of cash flows. That means how much cash this project or this investment is going to generate. Investor is always interested in cash. And these cash flows are realized over a period of time. That means suppose I'm making an investment of 1 lakh today, I'm not getting return immediately. Maybe after 1 year, I get 10,000. Maybe after 2 years, I'll be getting 20,000. Maybe after 3 years, I may be getting 30,000. Like this. That means my cash outflow or investment is made today. That is at time point 0. Whereas my inflows will be coming in future. It may be after 1 year, after 2 years, after 3 years. We call it as D1, D2, D3 like this. And in these future years, all of you are aware of that the value of money diminishes. Therefore, the future cash flow, suppose after 1 year, I'm going to get 10,000. The present value of that money is not 10,000, it will be less than that. Let us say you feel the present value of that money is 9,000. That means that 10,000 needs to be discounted at the rate of 10%. So today's 9,000 is equivalent to 10,000 after 1 year. So if 9,000 is the present value, 10,000 is the future value. Or if 10,000 is the future value, 9,000 is the present value. This 10,000 is discounted 10% to arrive at the present value. So when you take investment decision, we do not consider the cash flows of future cash flows, not considered as it is. They are discounted and brought to their present value so that they can be compared with the present investment. Hope it is clear. There are some methods we discount the cash flow. There are some methods we call it as a traditional or non-discounted method, where the cash flows are not discounted. Therefore, the most technical method is the discounted method. The traditional method includes the payback period method or ARR, that is accounting rate of return method. Whereas the discounted method includes discounted cash flow, or discounted payback, net present value, internal rate of return. There is a concept of modified IRR, and BCR, that is benefit cost ratio or profitability index. These are some of the methods through which we are able to take capital budget in this. Now, friends, the concept I told you, future cash flows, value of future cash flows are different. Value of present values, present cash flows are different. So this particular table shows the present value factor table at different percentages. Let us say you want to discount the cash flows at 9%, and cash flows will be realized after 3 years. You can refer to this 9% column, 3 years row. Here point is 0.77. If you multiply the cash flow with 0.772, it will get discount. That's the concept. Okay. Now, friends, I'll be showing you, giving you some idea about the first technique, which is about the payback period. Payback period means if I'm making some investment, how long or by which period the project is paying us back. That means by which time my investment money is recovered. You see, this is a method. Let us say first look at this question. Let us say there are two projects, Project X, Project Y. Project X, there is an investment of 110. Project Y, there is an investment of 110 again. Project X gives me cash flow like 31, 40, 50, 70 over a period of 1, 2, 3, 4. Project Y giving me consistent return 45 each. Question is, which project is to be selected? Yes, question is saying time value of money is 10%, with discount rate is 10%. Now, first we apply the cash flow method. So we are not going to discount the cash flows. Look at this table here. You'll be able to understand. Year 0, investment is 110. There is nothing is recovered from the project. So my unrecovered cash flow is again 110. Year 1, 31 is recovered out of 110. 31 is recovered. So 79 is unrecovered. Okay, year 2, 40 is recovered. That means out of 79, 40 is recovered, 39 is unrecovered. Year 3, 50 is recovered. That means entire 39 is recovered and project start giving me positive cash flow. That means the payback period here is 2 years plus some months. During third year, project is started giving me positive cash flow. That means during the third year, the initial cash flows are recovered. Okay. If you want to calculate what is the exact month or days of the payback period, you can use the formula. Base year plus unrecovered cash flow in the base year divided by cash flow in the next year into 12 months. Base year is the year at which unrecovered cash flow was negative for the last time. You see, unrecovered cash flow negative is 2 is the second year. Here it is negative. So year 2 plus unrecovered cash flow in the base year, that is 39, divided by cash flow in the next year, that is 15, into 12 months. So if you convert, it will give you 2 years plus 39 by 50 into 12 months. That means 2 years plus 9 months, some days. If you convert it into days, it will get 11 days. This is how payback period is computed. And on that basis, projects are selected. A project where cash payback period is less is a good project over the project where cash payback period is more. This method suggests this. Same way, project Y also can be evaluated. Project Y use payback period comes to 2 years, 5 months, and 8 days. So project Y is also acceptable because in the question there is saying the target payback period is 4 years. So both the cases, we are generating positive cash flow earlier to that is earlier to 4 years. But you compare project X and Y is having low payback period, so Y should be selected. This is how, by applying this method, one selects a project. right? Now, one more method is ARR, that is accounting rate of return method. In this method, what happens, you see, we calculate the average profit to initial investment. Okay, if you look at here, or average profit to average investment. So, first step is that we'll be computing part profit after tax. Then compute what is the opening investment, what is the closing investment, find out the average investment. Then calculate ARR, average profit by. There are two school of thoughts. One thought says you can calculate the profit after tax on initial investment. The other school of thought says no, you calculate it as an average investment. You may follow any method. Results will be different, but doesn't matter. If you're comparing project, each project should be, each project's ARR should be computed by following a consistent method. Okay. If you're deciding one formula, that formula needs to be consistently applied for all projects. Okay. So how to compute average investment? Opening value plus closing value divided by 2, you can decide. Here is, you see an example. These are the cash flows of two projects. Similar example. Okay. You have to calculate ARR. Target ARR is 10%. Question says straight line method of depreciation. That means each year depreciation is 27.5. That is 110 is the investment divided by 27.5 divided by 5 years. So you can get divided by 4 years. You can get 27.5. So the profit is, this project has given you cash flow. So profit is calculated as cash flow minus depreciation each year. Total profit is 81. So if you calculate average profit of 4 years, it is coming 20.25. Okay, 81 by 4. Now, if find out average investment is 55. So ARR can be 18.41% if it is based on initial investment. That is 20.25 divided by 110. Or if you follow average investment method, then 20.25 divided by 55. So it may be 18.41% or 36.81%. So this is how ARR is computed. If it is more than the target rate of return, projects can be accepted. Similarly, friends, there are other methods are there, like discounted payback period method. Okay, net present value method, IRR method. So all these methods will be taught to you. Separate videos will be uploaded in the channel. You'll be going through that. Just a minute. Yeah. For all these methods, there will be separate video. Now, what we'll be doing, I'll be taking you to the contents of our syllabus where we are supposed to learn about the risk analysis. Just a minute. Okay. Now, projects risk we'll think of. I have already told you earlier what is a risk. Risk in the context of investment decision refers to the possibility of variability of return. If you're expecting returns are going to vary, then there is a risk. Okay. How the risks are measured? There are, you see, uh, there are different ways of measurement, in fact. So one can calculate risk like this. First of all, the range of return method. Range of return means you can say what is the highest possible return, what is the lowest possible. But highest possible return is 25, lowest whatever return is 2. So you can see the gap. Gap is more means risk is 2 to 25. Gap is 23. right? So 25% versus 2%, you can find out the gap. That is one way. And different projects will be finding out what is the range of return. Okay, difference between high and low. High-low analysis, you can say. Then another way is to compute the variance of standard deviation. Here's how standard deviations are computed, you see. For each project, we'll be finding out what is the probability of returns. For example, in this particular project, the return is given in the column X, column 2, second column. These are the possible returns: 6, 12, 20, 27, 30. If you average it out, you'll find out the average is 90. And the probability of each return is given in column 1. Okay, 0.05, that is 5%. Second is 0.2, that is 20%. Third is 50%, that is 20%. Then again 0.5. So these are the probability, these are the return. We are supposed to compute standard deviation. That is deviations from the standard. If there is a deviation from the standard or deviation from the average expectation, you can say there is a risk. Now, first, next column, we have computed the deviations. Deviation is x minus x bar. X bar is the average of x, which is 19. So 6 minus 19 is minus 13. 12 minus 19 is minus 7. 20 minus 19 is 1. So these are the deviations in this column. Then you compute a deviation square called as d squares. These deviations are squared off so that there will not be any negative number. Now everything becomes positive. Okay. Now this d squares are again multiplied with the probability. That means this d square column multiplied with p probability. That is pd square. Pd square, you got it. Probability of deviations in this column talks about pd square. Then sigma pd square, that is total of this pd square, comes to 37.6. If you take a root over of this thing, 37.6, that is sigma 1 to 1, 1 to n into pd square, then whole root of that. You will get the standard deviation. And this is understood at the risk of the project. Understood? This is one way of computation of risk. We wanted to learn the concept of computation of risk. This is how it can be computed. Okay. Now there is a relative comparison of risk also, which is called the coefficient of variation. So there are, let us say, 2, 3 projects or multiple projects you want to do a relative comparison. Then you can also compute coefficient of variation. That is standard deviation divided by expected value of cash flows. By doing this, you'll be able to compute what coefficient of variation, which can be used as a comparison of the risks involved in different projects. Now coming to analysis of the risk in the area of project. So these are the various types of risk we see. One is standalone risk, which is there in the project, associated with the project. Second is a risk which is associated within the farm or corporate risk or within farm risk. This is the overall risk of the farm along with other investment proposals. So standalone risk is one type of risk, corporate or within risk is one type of risk. Third is market risk or systematic risk. This is the risk which is associated with the entire market. We call it as the market risk or systematic risk. Okay. So these are the types of risk we see in the project. Now, if you try to analyze this risk, okay, now you can see these are the various methods of analyzing the risk. We'll stop here for the time being. We'll take a break. And very soon, we'll be starting one more session where we're learning about the risk analysis. This class, I tried to explain you what is risk. Okay, how to analyze that thing, we'll be learning in the next session. Thank you.